This is a gold chart, the price action from the last 5 trading sessions. To most people, it looks orderly. Gold closed Friday at $2,847 per ounce, up $23 from Monday's open. A solid week, nothing unusual. The kind of price movement that suggests stability, that suggests the market is functioning normally, that suggests you can go home for the weekend and expect Monday to open within a few dollars of Friday's close. That assumption is about to be tested. In the next 48 hours, while Western markets are closed and most investors are sleeping, 3 separate events will converge in ways that the gold market has never experienced simultaneously. Any one of them could move prices by $50. Together, they could create a gap that makes Friday's close irrelevant, an opening price on Monday so far from where we closed that stop losses don't trigger, hedges don't protect, and positions that looked safe at 4 p.m. Friday are underwater before most Americans wake up. I'm going to walk you through exactly what's happening this weekend, why the gold market is uniquely vulnerable to a gap, and what the positioning data tells us about who's about to get hurt. This is not a prediction that gold will gap. It's a warning that the conditions for a gap are present, and that anyone with gold exposure needs to understand those conditions before the weekend. Here's what they're not telling you. Gold doesn't trade continuously like cryptocurrency. When the COMEX closes at 5 p.m. Eastern on Friday, the primary price discovery mechanism for Western gold markets goes dark for 17 hours. Gold still trades during that window, on the Shanghai Gold Exchange, in the Dubai spot market, through over-the-counter dealer networks. But those prices don't set the benchmark that most Western positions are marked against. When COMEX reopens at 6 p.m. Eastern on Sunday, it must reconcile with what happened in Asian markets while it was closed. Usually this reconciliation is smooth. Gold moves a few dollars in Asia. COMEX opens a few dollars away from Friday's close. The gap, if any, is negligible. But when significant news breaks during the Western weekend, when something happens that changes the fundamental picture for gold, the reconciliation becomes violent. Gold can gap $30, $50, even $100 between Friday's close and Sunday's open. Anyone with a stop loss set between those prices discovers that their stop didn't execute at the price they set. It executed at the first available price, which might be far worse than they planned for. This weekend, the conditions for a significant gap are as extreme as I've seen in 15 years of watching precious metals markets. Event 1. The Shanghai Gold Exchange Premium. On Friday, physical gold in Shanghai closed at the equivalent of $2,911 per ounce, $64 above the COMEX close, a 2.2% premium. That premium has averaged $8 to $12 over the past year. It briefly hit $40 during the 2024 banking crisis. It's now at $64 and widening. The premium reflects physical demand in Asia that paper supply in the West isn't satisfying. Chinese buyers are paying $64 more per ounce than the price your brokerage shows because they want metal they can hold, and that metal isn't available at Western paper prices. Every day that premium persists, arbitrage pressure builds. Someone will buy COMEX futures, demand delivery, ship the gold to Shanghai, and pocket the spread. That process drains Western inventories and tightens supply further. But here's what's changed. The arbitrage isn't working anymore. COMEX delivery times have extended from 2 days to 8 days over the past month. Dealers report difficulty sourcing metal for physical settlement. The arbitrage that should close the premium can't execute because the gold isn't there to arbitrage. When the arbitrage mechanism breaks, premiums don't correct. They widen until demand destruction kicks in, or until Western prices rise to meet Asian prices. That reconciliation could happen this weekend. It could happen in a single candle on Sunday night. This is where the lie becomes unsustainable. Event 2 is happening tonight, while you're sleeping. At 11 p.m. Eastern, 8 a.m. Sunday morning in Beijing, China's National Bureau of Statistics will release January economic data. The release includes industrial production, retail sales, and fixed asset investment. But the number that matters for gold is none of those. The number that matters is the People's Bank of China's gold reserve update. China updates its official gold reserves sporadically and strategically. They went silent for 6 years between 2009 and 2015, then announced they'd accumulated 600 tons without telling anyone. They've been providing monthly updates since 2023, but the updates are widely believed to understate actual purchases. The official number is 2,264 tons. Independent analysts tracking import data, domestic production, and visible accumulation estimate actual holdings between 5,000 and 8,000 tons. Tonight's release is different. 3 separate signals suggest China may announce a significant reserve increase. First, Chinese state media published 4 articles in the past week discussing the strategic importance of gold in monetary sovereignty, language that typically precedes policy announcements. Second, the PBOC governor gave an interview Thursday in which he mentioned ongoing reserve diversification, without specifying assets, the kind of non-denial that often precedes confirmation. Third, satellite imagery of the Beijing Central Depository shows unusual activity consistent with large-scale metal transfers over the past 72 hours. If China announces tonight that its gold reserves have increased by 500 tons, or 1,000 tons, or any number significantly above expectations, the implications cascade immediately. It confirms that central bank demand is stronger than reported. It suggests official sector buying has been absorbing supply that should have flowed to Western markets. It validates the Shanghai premium as reflecting real scarcity rather than temporary dislocation. Gold in Shanghai is already $64 above COMEX. A reserve announcement could add another $30 to $50 before Western markets open. And Western markets would have no choice but to gap up to meet the new reality. Event 3 happens before COMEX opens on Sunday night, but after the China data drops. The World Gold Council publishes its Q4 2025 Gold Demand Trends report at 5 a.m. Eastern Sunday, 1 p.m. in London, perfectly timed for European markets to digest before Asia closes. This report contains the most comprehensive data on physical gold flows, central bank purchases, jewelry demand, bar and coin investment, ETF holdings, industrial use. Advance indicators suggest the report will show record central bank buying for the third consecutive year. Not just China, Poland, Turkey, India, Singapore, Czech Republic, and a dozen smaller central banks have been accumulating gold at a pace not seen since the collapse of Bretton Woods. The preliminary estimates leaked to Reuters last week suggest 2025 central bank purchases exceeded 1,100 tons, roughly 25% of annual mine production absorbed by official sector buyers alone. This matters because it changes the supply-demand equation in ways the market hasn't priced. If 25% of new supply is being absorbed by price-insensitive central banks, only 75% is available for jewelry, investment, and industrial use. That's a structural deficit that persists regardless of price. And when markets realize the deficit is larger than their models assumed, they reprice. The World Gold Council report at 5 a.m. Sunday, combined with whatever China announces at 11 p.m. Saturday, combined with a Shanghai premium already at $64, creates a 3-hour window where fundamental news is hitting an illiquid market with no Western price discovery to absorb it. That's the window where gaps happen. When positioning is this extreme, gaps don't just move prices, they cause casualties. The Commitment of Traders report released Friday afternoon shows positioning that makes the gold market a coiled spring waiting to release. Managed money, hedge funds and commodity trading advisors, are net long 287,000 contracts. That's 28.7 million ounces of paper gold exposure, concentrated in the hands of momentum traders who buy strength and sell weakness. When gold goes up, they add. When gold goes down, they liquidate. On the other side, commercial traders, the bullion banks that make markets and facilitate physical flow, are net short 312,000 contracts. This is normal. Commercials are typically short because they're hedging physical inventory or facilitating client demand. But 312,000 contracts is elevated. It's 28% above the 5-year average. The banks are more short than usual. Now add a third layer, the other reportables category, which includes foreign central banks, sovereign wealth funds, and large institutions that don't fit neatly into managed money or commercial buckets. This category has gone from net short 15,000 contracts a year ago to net long 47,000 contracts today. A 62,000 contract swing in positioning, 6.2 million ounces of buying, by entities that don't chase momentum and don't get shaken out by volatility. The setup is this. Momentum traders are long and will add on strength. Banks are short and will cover on sustained moves higher. Central banks and sovereigns are already long and are unlikely to sell. If gold gaps up Monday, there's no natural seller until prices rise enough to trigger profit-taking from the momentum funds, and they typically don't take profits on gaps. They add to positions. A gap up could become a vacuum, a self-reinforcing move with no resistance until it exhausts itself. Less than 36 hours remain before COMEX reopens Sunday evening. Between now and then, anyone with gold exposure, long or short, physical or paper, direct or through ETFs, should understand what they're holding and what happens to that position if gold opens $50 or $100 away from Friday's close. While one side waits, the other side positions. The entities that move markets aren't waiting for Monday. They're positioning now, in ways that won't be visible until after the fact. At 4:47 p.m. Eastern Friday, 13 minutes before COMEX closed, a single order for 12,000 gold contracts executed across multiple exchanges simultaneously. That's 1.2 million ounces, roughly $3.4 billion in notional exposure, placed in the final minutes of the trading week. The order was large enough to move price by $6 on execution. We don't know who placed that order. The CME doesn't disclose identities, but the characteristics suggest it wasn't a hedge fund closing a position. They would have worked the order throughout the day to minimize impact. It wasn't a retail trader. The size is institutional. It was someone who wanted exposure before the weekend, was willing to pay the market impact cost, and didn't want to wait for Monday. Someone with $3.4 billion to deploy thinks something is happening this weekend. I don't know what they know, but I know they acted on it, visibly, in the final minutes of the week. That's a signal worth noting. This is what a market looks like before a gap, not after. The gap, if it happens, will be obvious in retrospect. Everyone will point to China's reserve announcement, or the World Gold Council data, or the Shanghai Premium, and say, of course gold gapped. Look at the catalysts. But right now, in this moment, the gap hasn't happened. The catalysts are lined up but haven't fired. The positioning is extreme but hasn't resolved. The arbitrage is broken but hasn't forced a reconciliation. This is the window where understanding matters, where knowing what's happening allows you to make decisions before the decision is made for you by a market that moved while you were asleep. Some will read this and do nothing. Will trust that gold gaps are rare. Will assume that $2,847 on Friday means something close to $2,847 on Monday. We'll go to sleep Saturday night expecting to wake up to a normal market. Those expectations may be correct. Gaps don't happen every weekend. The catalysts I've described may produce muted market responses. China may not announce reserve changes. The World Gold Council report may match expectations. The Shanghai Premium may narrow rather than widen. But the conditions for a gap are present. The catalysts are scheduled. The positioning is extreme. The arbitrage is broken. The late Friday institutional order suggests someone is betting on weekend movement. Others will review their exposure, will check their stop placement and understand that stops don't protect against gaps. They merely execute at the gap price, which could be far from the level they set. Will consider whether their position sizing accounts for overnight risk in a market that trades globally but clears locally. The informed are not predicting Monday's open. They're preparing for multiple outcomes. They're recognizing that a market with a $64 physical premium, scheduled central bank data releases, extreme speculator positioning, and broken arbitrage mechanisms is not a market where Friday's close guarantees Monday's open. This is not financial advice. This is not a recommendation to buy gold or sell gold or hedge exposure before the weekend. This is simply a description of conditions that create gap risk and an explanation of why this particular weekend has more gap risk than most. $2,847 on Friday, 3 events over the weekend, 36 hours until COMEX reopens. The gap, if it comes, won't ask permission. It won't wait for your stop to trigger at your price. It won't respect the orderly assumptions that make portfolio management feel safe. It will simply appear, a number on a screen Monday morning that has no relationship to the number you saw Friday afternoon. And by then, the decision will already be made. By Beijing, by the World Gold Council, by whoever placed $3.4 billion in orders at 4:47 p.m. Friday. Your job, in the next 36 hours, is to decide what you're comfortable holding if they're right about what's coming. Because when gold gaps, it doesn't warn you, it just moves.